Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I'm Ryan Nauman, the market strategist here at Zephyr. It's widely known that investing in emerging market debt can help increase portfolio diversification and provides higher yields. However, there's a lot more to consider when investing in emerging market debt, like politics, the US dollar, interest rates, and all those things have been very popular in the headlines this past week. Well, I had the perfect guest on to discuss these topics and much more about emerging market debt. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to give a very warm welcome to Stuart Sclater-Booth. Stuart is the Deputy CIO and Portfolio Manager at Stone Harbor Investment Partners. Stuart, thank you so much for coming on the show. It's such an honor to have you on. Can you please tell us a little bit more about yourself and Stone Harbor Investment Partners?
Absolutely. Ryan, thank you so much for inviting me to be on Adjusted for Risk. As you mentioned, I'm the Deputy CIO of Stone Harbor Investment Partners. Stone Harbor is an emerging market debt boutique that runs long-only strategies across emerging markets debt. We have funds that invest in sovereign dollar debt, emerging market corporate dollar debt, so corporates in emerging markets, and emerging market local currency debt, primarily sovereign local currency debt. And then we also have funds that allocate across all three sub-asset classes as well. Stone Harbor has been investing in emerging markets since the late 1980s, one of the sort of pioneers in the asset class. Previous incarnation was originally with Salomon Brothers Asset Management. The team founded Stone Harbor in 2006 as an independent firm. And more recently, in 2022, we became an affiliate of Virtus Investment Partners and are the sole emerging market debt manager for Virtus. I joined Stone Harbor in 2014 after initially starting my career at the Federal Reserve Bank of New York, where I was a researcher and assistant economist. Then moved on to JP Morgan in emerging markets, where I was responsible for trade strategy and then proprietary trading. And after that, moved to Goldman Sachs before joining Stone Harbor. The great thing about joining Stone Harbor 10 years ago was that I really had the longest interview in the world. It was basically a 20-year interview, as the firm was one of my top clients when I was in the research departments at Goldman and JP Morgan. So I've known the team for a very, very long time, and that's one of the best things about joining people that you've worked with and respected for a long time is that it makes a very easy and seamless transition. So it's been a great 10 years.
Fantastic. Stuart, that's great. A couple of things. Number one, Stone Harbor has a wealth of experience in emerging market debt. So much knowledge there in this space. And then with you, it's interesting. I love the fact that you started with the New York Fed. So it's great you kind of know the underpins of the Fed. And then now you've got all this experience working at Goldman and now Stone Harbor. So a ton of experience here.
It's been lucky to work with some really high quality people across my career, and it's great to work with Stone Harbor, where we have a team that's been around for a really long time in emerging markets and works well together.
Yeah, fantastic. Yeah, I'm very fortunate too at Zephyr. I've worked with some amazing people. You'll just learn so much. You take so much in as long as you're willing to learn and take it in. I've been very fortunate also. So Stuart, let's just get straight to the point here. The election. As we're recording this, it's official that Donald Trump is going to be our next president. Let's just get straight to the point. It's on top of everyone's mind across the globe. We all hear about the impact Trump is going to have and his policies are going to have on just US markets, bond markets, the dollar, equities. Not a lot has been made about his impact maybe on emerging markets and emerging market debt specifically. What impact do you believe the next 4 years are going to have with Trump being president on emerging markets?
That's a great question, and one that's, incredibly topical. Um, you know, the the core elements of Donald Trump's economic plan, and what he's campaigned on are tax cuts, deregulation, and tariffs.
Mhm.
Um, and these have, cross currents of their impact on both U.S. markets and global economics and markets as well. So, on the tax side, you have an likely extension of the 2017 tax cuts. They're scheduled to expire next year. You're likely to get a reduction in the corporate tax rate, as well, and an increase in exemptions. You're likely to see, deregulation. And this may have some positive short-term effects, on US GDP. We're going to see an increase in the deficit, um, and then you're going to have tariffs too. Tariffs, we believe Donald Trump believes in them. Full stop. They're part of his policy. He's been very clear on that. But he also believes in reciprocal tariffs, and so, to that extent, they can be scaled up and scaled down, depending on what our trading partners do. So, the proposals are, a 10% across the board uh, tariff hike and a 60% hike versus China. There's also likely to be some targeted ones: auto sector, in Europe, the auto sector in Mexico. Um, Implementation of them, there's some discussion internally. We have thoughts that perhaps the ones on China can be done unilaterally without Congress. There's under Section 232, which is national security. Um, and then, the across the board tariffs may have some procedural issues. So a little bit to be seen on that. I think the timing is uncertain. We're all talking about it right now, and markets are reacting to things right now. But we also know that Trump is not taking office until late January. There are many other things that are going on, in his first 100 days. So there's, uncertain timing. There is calibration along with how they're going to be implemented. Is this something that's going to be implemented in one shot, or is it going to be a deliberate, slow process, which allows time for reaction for our trading partners to see what they want to do? Is that, can we reach an agreement on other elements of trade, for, increased exports of agricultural products, for instance, that happened, in 2017. Um, you know, Also allows time for markets and companies to adjust to increasing tariffs. So I think there's a lot of questions still out there on what the tariffs look like, but there will be an impact on emerging markets. And again, it's a little bit of pros and cons. On the plus side, we do think the initial stimulus of U.S. growth is actually a positive for global growth. And what we found with emerging markets, there's a lot of focus, obviously, on China, and I'm sure we'll get to that later in the conversation. But we actually find that emerging markets growth, ex-China, is more sensitive to U.S. growth than any other major region. And so U.S. growth is a positive for emerging market growth. Tariffs, can be a drag on growth if we start getting into an escalating trade war, and so that's something that we do have to watch out for. Um, the shift in tariffs is probably going to be a move higher in the dollar. That is, the natural adjustment mechanism for trading partners is to allow their currencies to weaken versus the dollar. And the question becomes, how much of that is already priced? How much does that already happen? We did see, very large sell-off in emerging market currencies really from mid-September on, and that was as the election odds were beginning to shift. And you could see it in the predictive polls, you could see it in the poly market. As those election odds were increasing, we saw a significant appreciation of the dollar and depreciation of emerging market currencies. So to an extent, a fair amount of this is priced in, and we actually saw really interesting price action on Tuesday night during the election as the polls were coming in and Trump was outperforming market expectations, and people thought it may be a few days before we found out the election results. But when it became clear that he was leading, you began to see a big move higher in the dollar relative to emerging market currencies. And the Mexican peso is one that people watch. It trades very actively, liquid overnight, and it moved up to almost 21 pesos to the dollar. So that was about a 2.5%, 3% depreciation on the election news. Yesterday it closed below 20. So it tells you that there already is some premium in these currencies, and so the impacts on the currencies, while the dollar will be stronger, it may not be. It's not a surprise. People have positioned for it. Currencies have already weakened a little bit.
Mhm.
But we do think that it would be ultimately, if the full element of tariffs are put in place, you can see a particularly 60% tariff on China probably is around a 10% devaluation in the Chinese currency.
Such great information, Stuart. Thank you for sharing all that insight. Do you think so? During Trump's first term, emerging market equities, the MSCI Emerging Market Index, performed really well. I think was up double digits during that 4 years. Emerging market debt, in local currency terms, was up 5-6%. So performed pretty well. Do you think that helps? During this term, is we can go back and compare history. I know history doesn't repeat itself, but it rhymes. And there isn't that uncertainty that we had during that first term. You think that helps price in some valuations here?
I think it does. I think there is one is we've seen the experience as you mentioned. The other I think that's important is initial conditions are quite different for many emerging markets than they were in 2016. If you go back to 2016, emerging market countries were running big trade and current account deficits with the rest of the world. So they were importers of capital. And when you began to see the dollar strengthen, and you began to see in 2017 and 18 interest rates begin to move up from the Fed, these were headwinds for many emerging market countries because they effectively came in a position of somewhat overheating. They had a lot of credit that was built up, and that was reflecting sort of these trade deficits that they had, and their currencies were strong. Currently, you have big current account surpluses in emerging markets debt, and that reflects not only the sort of big appreciation of the dollar over the last, really, almost 14 years. It's been a pretty one-way appreciation of the dollar. But you've also had really good monetary policies from many emerging market countries. They were very quick to hike interest rates, when inflation began picking up post-COVID. Brazil was 9 months ahead of the US in terms of hiking interest rates. And so they've built a lot of buffers that we think allow them to withstand some of the potential shocks that might come from escalated trade tensions.
Good insight. So like I said, it doesn't repeat itself, but rhymes, and there's a lot of uncertainty out there in terms of, and then we have interest rates. You brought up interest rates. There's so much at play right now. You got the election, now you got the Fed in its rate cutting cycle. A lot of things at play that investors have to kind of sift through when it deals with emerging markets. So you mentioned China. Again, it's kind of like the election. You can't talk about emerging markets without talking about China. few months ago, it made huge news about the large economic stimulus, which gave concerns about what really is going on with the Chinese economy. What are your thoughts on the stimulus? And then now you've got potentially, like you say, 60% tariffs on China. What's your thoughts on China moving forward?
Sure. Like it's one of the most important countries that we look at for its own investment opportunities and for its impact on the rest of the world. Even though we do think U.S. growth is more important for emerging market growth ex China, China is still quite important. There's a lot of structural weaknesses. There's a lot of debt that's built up over the last 20 years. The housing sector is still in a process of healing, and is incredibly weak. And so it's really at risk of debt deflation. The third quarter was quite weak in economic growth, with some people saying that actual GDP, as opposed to reported GDP, could have been close to zero. Inflation is barely positive at this point. You have core inflation at year on year at 10 basis points. So with large amounts of debt, having deflation, that creates a very potentially negative cycle. What we have seen is an awareness by policymakers in the Politburo to intervene and to protect against the downside. So we've seen much more active monetary policy and reducing rates and reducing reserve requirements and lending ratios. And we've begun to see in a step towards more fiscal support. Yesterday or overnight, China announced that they would be issuing $6 trillion of special opportunity bonds to support the local governments, and that they would be increasing fiscal spending by 1.4 trillion as well. So that is a recognition of how fragile the economy is. However, it's not we don't think it's shock and awe. And so if you look at the fiscal spending they're talking about, and we're still awaiting details, so it's not everything is laid out, but 1.4 trillion is equivalent to around 1% of GDP, a little bit less than 1% of Chinese GDP. In 2009, 2010, the numbers were closer to 12%. So this is not we are trying to re-stimulate the economy and get to a higher growth trajectory. Is to really limit the risks of debt deflation, negative downside events, and a housing collapse, as opposed to allow a slow healing process to take place in the housing sector, where you are seeing prices finally clear at lower levels, and you're seeing sales still declining, investment still declining. So they need to work through this problem, and this buys them time to do that. So we see it as protecting sort of that growth levels in the 4.5 to 5% area, rather than trying to get to a new trajectory of 6-7% type of growth.
I'm really glad you brought up the point of, you kind of look at China by itself sometimes. And I'm a firm believer when investing in emerging markets, whether it's equities or debt, you want to take an active approach. All emerging market countries, they're not created equally. And China is such a big allocation to these indexes. What's your thoughts on that in investing in emerging markets? Is it something where you kind of have to take them in separate pieces, or do you group them together?
No, we're very much of a bottom-up oriented manager, and so the emerging markets are kind of interesting in that in many ways it's the whole world minus the G10, right? So there's a lot of countries out there, and many are incredibly high quality investment grade countries. Think of countries in the Middle East, Saudi Arabia, Qatar, the UAE. These are A-rated, double A-rated credits. And then you have countries that are coming in and out of default, Argentina, Ecuador, Zambia, Ghana, Sri Lanka, and so it's a while we talk about them as, one asset class, you do need to be very, very selective in your investing profile. So when we look at China, um, we focus on it because of its important role, but we don't see a lot of exciting investment opportunities in China. The good news is that in the debt universe, the Chinese markets are actually relatively constrained in the indices. And so, in the hard currency sovereign index, it's around 4.5, 5% of the index. In the local currency, it's around 10%. So we're not talking about 25, 30% type allocations where you're investing in equities and really you're buying China and a bunch of other things. If you invest in emerging market debt, it's a much smaller part of the index. In our sovereign funds, we don't own any China, for instance.
Okay.
So it's able to you're able to construct portfolios that are really attractive and not necessarily invest in countries that you think have underlying fundamental weaknesses or don't pay you for those weaknesses.
Yeah, and I also find interesting too. I just saw a post on social media about demographics. We always are talking about demographics, and such a huge portion of the globe's population is part of emerging markets, whether it's India or China, and you got to take that in consideration too. I'm assuming when investing in these countries.
You do, and what's the opportunity there is that with these demographics and young populations that are growing, you have much better growth potential in many countries. And you think about sort of aging populations that have taken place in Japan or Europe, it's coincided with quite low growth. If you look at the age of the populations, and I'm throwing together sub-Saharan Africa as one investment. While of course there are many different countries there, but by and large, the average age of the population is very, very low. You look at Egypt, it's very, very low. So the growth potential for many of these countries are 7, 8%, as opposed to developed market growth, which is in a good case 2.5% would be a good growth number that many policymakers would be happy with. Certainly, Japan has had years of no growth. So having a young population and having demographics that are growing certainly increases the growth potential for many of these countries, which we think is helpful for servicing debt as the economies grow.
Interesting. Like I said, we talk a lot about demographics and the Great Wealth Transfer and all that, but I think that's one topic that doesn't maybe get talked enough about is the impact it can have on growth, especially in those emerging markets that you just discussed. You mentioned a lot of different countries there, um, within Africa or South America. What emerging market regions or countries do you find most attractive currently and moving forward?
Yeah, there's a lot. So again, as I mentioned earlier, we take a very much a bottoms up approach to our investments. So it may end up being regionally focused, but it's not necessarily regionally focused. It so happens that we do think some of the most interesting opportunities and reform stories and growth stories are in Latin America, Africa, and the Middle East. Argentina right now is a very interesting place. You have now 1 year on administration with President Milei, who's really overhauled the government there, overhauled the whole economic model, slashed the deficit. And this is after decades of fiscal irresponsibility, default after default after default, hyperinflation, and now he's essentially engineered a fiscally led recession to fight inflation and get the fiscal house back in order. So after years of fiscal irresponsibility and large deficits, Argentina now has got a fiscal surplus. Inflation is coming down from hyperinflation to high inflation, but it's moving in the right direction. Growth collapsed in the first half of 2024 as this sort of austerity measures were put in place, and now you have a bit of a recovery taking place. What is encouraging for the long-term prospects is that Malay's popularity has remained intact, and so so the population has been on board. with these economic sacrifices to get to a better place after decades of things not working. We also like Ecuador as a country, again, a very high yield country with a volatile political history, but a government that's in place that's running for re-election that we think will get another 4 years of opportunity there, has worked with the IMF to have a credible orthodox policy, has raised its international reserves and cut its fiscal spending. So again, a reform story moving in the right direction. In moving further east in Turkey, we've had a 180-degree shift to the approach to monetary policy. So in the past, President Erdogan was very involved with monetary policy, liked low interest rates, made it very clear to central bank governors that they needed to have low interest rates. If they didn't, they seemed to have a short leash. He's bought on to, out of political necessity, to the fact that orthodox monetary policy works. And so we're seeing a decline in inflation. We're seeing a very large trade surplus there, and we're seeing a big improvement in the central bank's balance sheets as well. So that's another reform story that I think is attractive. In Africa, we think Nigeria is very attractive. Again, they've taken on some hard reform measures. And then on the big countries, we think India, particularly in the corporate sector. There's a lot of really interesting opportunities there, particularly in green energy.
I love that you brought up those reform stories. A lot of times when you read about, you know, countries or regions that people like to invest, it's Thailand or Taiwan or, India. You don't really hear about Ecuador very often. So when you say reform stories, are you getting good attractive valuations there too? Is that part of your investment
Absolutely. Yeah,
thesis?
absolutely. So, we invest on, we want to make sure that we're getting compensated for the risks that we're taking. We believe that many of these countries were in a weaker position, a year or so ago, and so as a result, there was a lot of premium priced into the assets. So, Ecuador, for instance, front end yields, trade at 20% in dollars. So you're not taking currency risk, and you're earning 20% in dollars. And we think that with a successful completion of the presidential process and reelection of President Noboa, this could be something that trades at 12%. So you're going to get a lot of yield and hopefully a lot of capital appreciation in owning that asset. So most of these countries, particularly Argentina, Ecuador, Nigeria, Egypt, these are countries that have double-digit yields, have a positive reform story that we think will lead to further compression of those yields, and a return of capital.
Fantastic. Real quickly, you mentioned just with Ecuador, there's really no currency risk. And you also mentioned local currency versus hard currency. Real couple minutes. Can you kind of explain the difference? Obviously, we know the difference between local currency or hard currency. Maybe what are the benefits of local currency when investing in emerging market debt?
Yeah, that's a great question, and there's it's a complicated asset class, but it's really great opportunities. So local debt, essentially you can think of as a mix of foreign exchange risk and domestic interest rate risk. And so for investors, for U.S.-based investors, having a view on the dollars is paramount, for investing in emerging market local debt. If the dollar is going to be strong, it's difficult to see FX appreciation in emerging markets against the dollar. So that's something that really needs to be bear in mind. So you really need to have an FX view and an interest rate view. And the interest rate view is influenced by core interest rates, US interest rates or European interest rates, but these countries also have their own monetary policy cycles. And so you need to understand those as well.
Interesting. Yeah, we might have to have you come on more and just talk about that, the interactions of currency and yeah, between local and hard debt and so on. Stuart, such a fantastic conversation, a lot of fun. I learned a ton, and such a timely time to have you on too, with everything going on, falling interest rates. Then we have new president, tariffs, just a lot of stuff going on. Where can our audience get more information about Stone Harbor Investment Partners?
That's great. Well, I think the best one-stop shop is our website. It's shipemd.com. On there, you can learn more about the team. You can learn all about our products, our funds. We have an ETF as well. In addition, please listen to we have a weekly podcast,
Okay.
and we have other written content, weekly comments on credit, and a monthly investment policy statement. So, we love to get feedback from our clients. So take a look at what we have on our website, and we'd love to have dialogue.
Fantastic. Before this interview and talking with you, I went to your website. And I agree, some great content on there regarding some great education about emerging markets and just everything that's going on. So great research and content, thought leadership. Can't recommend it enough. Stuart, it was an honor to have you on. I really appreciate it. Thank you for sharing such great insight. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you and have a great rest of your week.